Hello everyone. Let's give you an overview of cash and internal controls. When studying cash and internal controls, we'll make sure that you understand what we mean by internal controls and then provide you with examples of what internal controls are. We'll look at cash and cash equivalents. This is a line item that will appear first on every company's balance sheet. We'll make sure that you understand what we mean by cash and cash equivalents. We will discuss the purpose of bank reconciliations and solve problems using the bank reconciliation format. Finally, we will discuss the statement of cash flows. You will learn why a statement of cash flows is important to a company, and you will know how to prepare a statement of cash flows. As you study internal controls, you'll find that companies have internal controls for three reasons. One, they want to safeguard the company's assets. They want to protect the assets that they have. Two, they want to improve the accuracy and reliability of accounting information. All companies want to make sure that they're presenting their results as accurate as possible. And three, they want to ensure compliance with laws and regulations. As you study accounting, you're going to find out that in business, there's always the chance for mistakes or bad things happening. Things happen, for the most part, for one of two reasons. Either errors are committed, which are accidental, because people make mistakes, or fraud takes place. Now, fraud is intentional. Fraud exists when people do bad things. The fraud triangle explains why people commit fraud. It breaks the reasons into three. One, they get the opportunity. Two, they rationalize it. Or three, they're just motivated. The first reason is that people are just given the opportunity. Because the company doesn't have good controls or solid internal controls, it allows the opportunity for people to do bad things. Another reason for fraud is rationalization, where people just justify fraudulent acts based on their perceptions of the company's ability to deal with them. They might just feel that the company is large enough where it doesn't affect the company anyhow, or the company will never miss what they've done. Third reason is motivation. In these cases, people feel that they have the need to do something. They just have to take care of something. As a result, they do bad things. To minimize risk, companies have both preventative and detective controls. Key preventative controls are the separation of duties, physical controls like cameras, having proper authorization, employee training, and controls related to e-commerce. These controls are designed to prevent fraud from occurring. Detective controls include reconciliations like the bank reconciliation you'll learn about, performance reviews, and audits. Both preventative and detective controls are designed to minimize the risk of fraud. Then there's regulations. The Sarbanes-Oxley Act of 2002, also known as SOX, is a key piece of regulation designed to minimize the risk of fraud in companies. When studying cash and internal controls, it's important that you understand what we mean by cash and cash equivalents. When business talk about their overall cash position, they're talking about either their cash on hand or cash in bank, foreign currency, or something referred to as cash equivalents. Cash on hand is their coins, their currency, the checks they've received, their debit card receipts and credit card receipts. Cash in banks are there checking accounts and savings accounts. Then there's foreign currency, and then finally cash equivalents. When we discuss cash equivalents, we're talking about short-term investments that have maturities no longer than 3 months from the date of purchase. 3 months from the date of purchase is the key benchmark for determining whether something's a cash equivalent. Cash equivalents will include money market accounts, treasury bills that fall within the 3-month range, and certificates of deposits. So again, when you hear businessmen discussing their cash position, they're really talking about their cash on hand, their cash at banks, their foreign currency, and their cash equivalents. You may have heard the phrase cash is king for businesses. Well, cash is king. In other words, companies rely on their cash position to be able to take care of their operating activities, financing activities, and investing activities. Because cash plays such a big role in business, it's important to ensure the accuracy of the cash position, to maintain the integrity of cash in the financial reporting, and to protect the cash that the company has. One way we do this is through bank reconciliations. By doing bank reconciliations, companies know how much cash they actually have and are able to protect their cash positions from fraudulent activities. During class, we will discuss the reason for bank reconciliations and show you how to prepare. The final topic that we will cover is the statement of cash flows. Like the income statement, the statement of stockholders' equity, and the balance sheet, the statement of cash flows helps tell the financial story of the company. The statement presents the cash inflows and outflows from operating activities, investing activities, and financing activities. It enables you to understand why cash has changed during the period and allows you to determine exactly what your cash position is. It provides a clear understanding of the company's liquidity, which is its ability to meet short-term obligations. You will not only understand the purpose of this statement, but you'll be able to prepare one. As business professionals, the expectation is that you'll not only know how much cash you have, but understand all the reasons for the changes that take place during the accounting period. That's it for a brief overview of cash and internal controls. It's my hope that giving you a little insight on each of these key topics will make the unit more meaningful to you as you look at its concepts and solve its problems. Thanks for taking time to watch a video. Take care.